Well, welcome to our Viltra event, provided to you, of course, by AMF Markets. Trade like 1%, mastering common trading pitfalls. Today, we will explore key challenges in trading and provide useful tips for success, hopefully with an aim to equip you, of course, with the necessary knowledge to trade like the few. And we're going to know actually how many these few are. So let's begin this 1 hour journey or so together and unlock the secrets to mastering common trading pitfalls. It's more of a common sense, to be honest, rather than any sort of secrets. It's just that we need to establish them and implement them into our trading routine. So starting off, of course, with the main objectives and the goals of this webinar today, we will be trying to get you to understand of the risks and mistakes that can hinder trading success, see how we can develop effective risk management and establishing disciplined trading habits, learning about strategy refinement and improving by both successes and failures, and trading while controlling emotions, making disciplined decisions to overcome bad biases. If you follow these, you can even print them and stick them to your wall. If you just follow these things as a goal, obviously this is not a list of things to do, but we will get there as well. These are the main objectives. So if you objectify your trading strategy around these 4 different things, you're going to see an improvement straight away. Now, our agenda is going to include why traders fail and why traders succeed. So what is this characteristic in both cases, or characteristics that lead to either failure or success? We're going to look at some statistics that they are shown from different surveys. We're going to look at the mistakes loser traders make, of course, mainly, but we're also going to see some of the less common mistakes. That, of course, the most common ones involve emotions, risk management, and a trading plan, not having a trading plan or lack of risk management, to be fair. And how we can actually start changing the probability towards our side by learning, managing risk, and of course our full trading system, how to strategize and how to evaluate. By doing this, of course, this is the sort of road path to more successful, to developing more successful trading habits. So starting off with kind of the losers and the winners, I wanted to tell you that everything is really based on one really thing, right? Why most traders fail, it's really come down to one thing. And this for me is perspective. And perspective, of course, it's something that comes from our own beliefs, our own biases, and our own personality. And this is why it's important to understand that when trading, what is more important is not what we believe, but is to understand how markets move, how we can adopt, and how we can improve. And without understanding this and making trading a serious job of our day-to-day life, then it's going to be very hard without changing perspective to think like what I like to say, like a marathon trader. And why do I like to make this connection is because marathon runners, they are having some specific characteristics and they go through certain things that traders can really use to their advantage, or they really need as well in order to succeed. And let's not forget, guys, marathon, okay, is a completely different thing to the sprint. Now, you're doing a sprint all this time, perhaps, but the reason you're here today is because you want to be a marathon trader. Why? Well, because marathon runners pace themselves and conserve energy for the long haul. The short term or the sprint we shouldn't let it blur our focus and our goal, which is long-term gains in our case. Marathon runners, they take care of their bodies and their minds to perform at the best whenever they go into the game, and that game for them is the marathon. They have a race plan that they follow to achieve their goal. Some of them decide to run the first 100 meters and very quickly get the lead, for example, and then just slow down from that all the way to the others prefer to preserve their energy, and without caring how much where they are in the beginning, and then give everything they have in the end. And this is how they also work out based on that specific goal. What does they do is that they take consistently over time to build endurance and improve their performance, okay? And finally, of course, they are consistent in their approach. They don't go and change. Of course, sometimes it depends. Maybe if you're running a marathon, how many turns it has, how long it is, and all that stuff really play their role. But we're talking about the approach now. We're not talking about the strategy, okay? Strategy should be adaptable, but the approach should never change, okay? We should always think of the long term, have our bodies and minds ready for trading, plan and follow the plan to achieve our goals, train consistently. That is our brain, as well as your body, if you wish, to build endurance and improve, and be consistent. You decide what you want to be. You can either be a marathon trader or a marathon sprinter, if you wish. Well, the marathon trader, there are some very important things that kind of can be like linked to the marathon runner. One is mental health. And the most important thing is that to ensure that you get enough sleep, you eat well, and that way, of course, you'll be able to manage your stress levels much better. Obviously, we all have a busy life. We do have a job. Maybe you have a baby, it keeps you awake. But even 5 minutes of sleep on a daily basis, it will give you that boost that you need. It will clear your brain to be able to achieve the success you want at the time of trading, or just like get a nap before going into trading. That is very important. Now, number 2, plan and patience. We wait for high probability setups to present themselves. This is what traders do. We don't go and search for a setup and we say, it's not as high probability, but I will trade it and we'll see how it happens. It's not how it works. We have to wait for certain conditions to occur, okay, to come to us. We don't go to them and then patiently and with a plan go into the markets if all the conditions are met. Number 3, persistence and adaptability. Adapting to changing market conditions and adjusting your strategy. The thing I was talking about before. We remain consistent in the process, but we have to adapt to changing market conditions and adjust our strategy based on this, okay, whatever they may be. And then consistency, of course, to avoid making impulsive decisions based on biases. For example, like if we say that someone has no patience, well, they will not have consistency either, if you know what I mean. Now, who are the biggest traders ever and why? Very important, why they made it through, why they became who they are. It's 4 of them: Jesse Livermore, George Soros, Paul Tudor Jones, and Ray Dalio. All of them they have different, of course, approach, right? Jesse Livermore, for example, he was able to adapt to changing market conditions. He was able to cut losses very quickly, and he had strict adherence to trading rules. He was very strict to trading rules, okay? And that was the magic recipe for him. Soros, on the other hand, he was able to spot trends early on time and capitalize on them. He would calculate his risks, and he was able to understand, or still is, by the way, I mean, 3 are still the best traders alive today. Understanding of macros. Paul Tudor Jones, he was very good in understanding psychology, and he had the ability to identify trends before they were visible, they would present themselves, and that is why, of course, he was willing to go contrarian, because when the trend is falling, when the trend is down, and without turning, if you're going to against the trend, you are contrarian. But if you have the ability to identify the trend before they kind of occur, then it means that you're a bit more risk taker, of course, but you are so confident on your strategy and method as well. And Ray Dalio, systematic approach and risk management was exactly what got him where he is today. His decision making has been all data driven. No one says you don't need to use a PC or make calculations or Excel sheets or whatever. You don't just need to look at Bollinger Bands. You can just look at take the numbers of the Bollinger Bands, because visually and computerized is a completely different thing. Well, computerized is what worked for Ray Dalio. And of course, continuous learning and development. It's actually much easier to also spot things that you may not have spotted visually, right, when you look at numbers. So this is something very important to keep an eye. Now, if you have any of these, don't forget that you have one of the recipes to one of the items of the recipe to success. So a combination, of course, could do, but even one of them could essentially just help you improve significantly. Now, I want to see some statistics first, guys. So you understand what is happening really in the trading world, okay? Look, well, 87% of all retail traders lost money based on research over the time span of 2022. This is 80% of all retail traders. You are a retail trader. Okay, that means that only 13% didn't lose money, right? That doesn't mean they made money, but didn't lose money, 13%. Of course, brokers have different statistics. Some have 90%, some are 60%, whatever. Now, 80% of retail traders quit within the first 2 years. And this is, of course, expected. If you are looking at 80%, 87% of them losing, why not they wouldn't stop after a year, the second year of losing money? So it is very important to understand that these numbers are not fake. We're talking about 8 people out of 10. They stop trading after 2 years because they fail. They just quit completely. Now, on the other side of the spectrum, look at this. 80% of prop firm traders make money consistently. And you might turn around and tell me now that, oh, well, they are prop traders. Yeah, they are prop traders because they made the challenge given to them. They made it through. And that means that they have been consistent before they took the challenge. The question is, what have they been doing? Good. Well, one of the things I might have been doing is any of what these lectures have been doing. You can do it too. And other things, of course, including, okay, learning from mistakes. We're going to look at the common trading mistakes, the less common trading mistakes, and we're going to actually speak about each one of them separately a bit. So the most common are, the main sort of, it's like a topic. It's not really a reason, but, it's emotional trading. It's the lack of risk management. It's the fact that most of the people have no trading plan. Now, less common reasons to they are considered as mistakes in trading is lack of diversification, is your failure to adjust your strategy, and herding behavior. I mean, this is the most common, less common, if you know what I mean, the herding behavior. So let's look at them one by one. When it comes to emotions, okay, there is 4 emotions that can trigger like different sort of can trigger our decision-making process. Fear, greed, hope, frustration. When it comes to risk and lack of risk management, we are looking at a trader who's over trading, or someone who has no stop loss, or very poor risk reward sort of plan, or probably all of them. Most of the case, someone who doesn't have stop losses will over trading, will have very poor risk management anyway. And those who don't have a plan. And the thing is that without the plan, guys, there's just no objective. I did start with pointing to you what are the objectives of this webinar. Okay. So if you don't want to leave yourself exposed and undisciplined, you need to have a plan, pretty much. Because without it, you have none of this. And if you don't have these, you cannot do this. And if you don't have these, These are going to be what is bringing trading to you: fear, greed, hope, and frustration, which means you are following the rest of the 87%. I'm sure it's not what you want. Now, let's go to emotional trading a little bit. It can be triggered, as we said, by a variety of factors, including the fears of fear, greed, hope, and frustration. Now, when you allow these emotions to dictate your decisions, guys, it leads to very poor trading outcomes. Okay, you're taking excessive risks, you're holding on to losing positions perhaps for too long. I've been there, I've done this. Or you cut off profitable trades very early because you're scared that the markets are going to turn. But by understanding the emotional drivers and taking the right steps to manage them before, of course, you see the result and the outcome come, and it's, you know, whatever it is, sometimes you might be lucky, but when you tell yourself, oh my God, I was lucky today, then you know something is wrong with this. This is the hope sort of, you know, thing that doesn't let you be more consistent and disciplined. But it will, of course, help you increase the chances of success. Now, let me tell you about what research says. There is some findings, okay? One of them, of course, regarding emotions, right? It's about poor decision making. And studies have found that when traders are experiencing strong emotions, they're more likely to make impulsive decisions that are not based on rational analysis. Excessive risk taking, like greed, can cause traders to take on larger positions that they are comfortable with or hold on to winning positions for too long, leading to significant losses in the event of a market downturn. And this is, guys, how most of you have hit margin in the past. Maybe even it's happening at the time as we speak and you don't know how to manage it. But, well, you don't need to know how to manage it. The reality is that you should have never been there. It's not easy to manage once it's done, you know. Detrimental performance is another one. Researchers have found that traders who are able to manage their emotions effectively tend to earn higher returns than those who are more reactive to emotional triggers. So even if you're winning, maybe you are lucky. And something important as a takeaway, meditation and deep breathing can help stay calm and focused, reducing the likelihood of impulsive emotion decisions. As I said to you before, practically take a nap before sleeping. I mean, you don't need to meditate or just do deep breathing. This is a complete different stage. You can get there too, of course, but initially start with something that you really need, taking a break. You know, it's not meditation, but this 5 minutes will boost your energy, will clear your mind. It's very important to start there. Now, let's just talk about fear, greed, hope, and frustration a little bit. Fear can cause traders to make impulsive decisions based on short-term market movements, rather than sticking to a long-term investment strategy. Okay, if you are long-term, fear is not going to be there. Not going to be there. Fear can also lead traders to exit positions too early, out of fear of losing money, or holding to losing positions for too long, hoping that the market will turn around, as we said before. Greed is another powerful emotion that can lead traders to take on excessive risk or hold on to winning trades for too long. Traders who are driven by greed may take larger positions that they can afford or become overly confident in their trading abilities. Another thing that is very, very, very important. And while hope is generally a positive emotion, it can be detrimental to traders who hold on to losing positions, hoping for a reversal that may never come. Traders who are motivated by hope may ignore the stop loss orders or add to losing positions in an effort to reduce their average entry price. Frustration can be particularly challenging for traders as it can lead to impulsive decisions or unwillingness to cut losses. Traders who become frustrated with the market may also become disheartened or lose confidence in their abilities, leading them to make emotional decisions and then, of course, quit after the second year. Do not tell me you haven't been there. We all have been there. Even the top, very top trader in the world has been there in every single stage. But they took it and they made it a winning recipe. So what are the very two important things for us to be able to make a start around controlling our emotions. First of all, we need to monitor our emotional triggers. Okay? So if you're aware what emotions tend to influence your decision at a particular time, even, you can take steps to manage them. Okay? Maybe, taking breaks is one way. Maybe sleeping before you trade is another way. Okay? Or when feeling comes, just like saying to yourself, okay, I'm taking a break, that's it. Or if you feel like, you feel a little bit of something, just, you couldn't be aware at least and be able to do something about it. And as I said before, the meditation, deep breathing, and visualization also can help traders stay centered and focused, even in challenging trading situations. Now let's go to the second sort of thing here, which is about the lack of risk management. Risk management is the process of identifying, assessing, prioritizing risks associated with trading and implementing strategies to reduce or manage those risks. Evaluating risks and rewards of a trade, determining the amount of capital that should be allocated, setting stop loss orders, and monitoring trades to make sure they're performing as expected are all part of risk management. The question is whether you like risk management or whether you don't. And knowing about what it is, it doesn't mean you are not liking. In practice, you have to apply it. Otherwise, you do lack risk management. And if you lack risk management, that means that you most often lose money because you are exposing yourself to unnecessary risk. And that, of course, results in significant losses. And then, of course, the trading account is all gone. So why do you need risk management? Well, because if you don't manage risk, you will probably go and take on too much leverage, invest too much of your capital, perhaps even in a single trade, ignore signals or your own rules about exiting a trade, or even fail to set realistic profit targets. All of them can really be improved, and you have a very big portion of your problem solved, because without risk management, you're not going to be able to change your emotions. You understand? So how can we fix that? Well, we need to use stop losses. We need to consider position sizing every single time. We need to monitor our trading performance. We need to educate ourselves, and we need to practice with a demo account if necessary. And most of the time it is necessary. So let's look at those one by one. Stop loss orders are essentially limiting potential losses and reducing the emotional impact of a trade. Did you hear that? Reducing the emotional impact of a trade. Set stop loss orders at a level that will protect your trade if the market moves against you. And that cannot be very tight. Well, that's your strategy, but you know what I mean. Position size is a thing that can help manage risk by adjusting the size of each trade based on the trader's risk tolerance and investment goals. This can help reduce the overexposure to risk. And this is just not talking about I'm going to go and do 1% per trade. You could visually see that you have high probability setups and less high probability setups. Based on these chances, you can also do 0.5% on a stop loss, or 1% or 2%, but don't ever go more than 2-3% per trade. Okay. Monitor trading performance. Keep track of your trades and monitor your performance to identify any trends or patterns that suggest a need for a change in risk management strategy. Education. You can seek education from industry professionals, online courses, and trading books to learn more about effective risk management strategies. And of course, practice with a demo account can provide you with an opportunity to test out different risk management strategies without really risking real money. You can backtest, you can test, you can lose money, you can do whatever you want in the practice account. It doesn't matter. You're only learning from this. Now, those who don't have a trading plan, and we have actually switched to the plan sort of components will perform worse than those who do, because the trading plan provides structure and a discipline to trading approach. Without it, traders make impulsive decisions or react emotionally to market movements, which can lead to poor performance. Now, a good trading plan should include clear guidelines on when to enter and when to exit trades, how much capital to allocate to each trade, what risk management strategies to use, and what targets to aim for. Also, this is not just that, but this is what the should is. For example, something else could be, for example, part of risk management, how much capital to allocate to each trade we're talking about, right? And what risk management strategies to use. So within these two, for example, let's say you can have 1% for each trade, but you have to have a limit. I'm not gonna have 3 trades open at the same time, for example. If you have 3 trades open, that's it, you just let them go. Do their thing, and then you see, based on that, how you want to continue. Because if you take 3 losses, well, you wouldn't want to have another 2 trades open, would you? But if you had only 1 loss and 2 wins, then you'll just continue as normal. It's important to manage risk. And this, of course, would help against overtrading. Now, by developing a well thought out trading plan, you can reduce the impact of emotional decision making and keep focus on the long-term trading goals. A trading plan also helps traders to assess their performance and identify areas for improvement by keeping track of their trading results. Traders can analyze strategies and adjust them accordingly to optimize their performance. So what are the benefits of a trading plan, of having a trading plan? Well, number 1, it helps manage risk. Number 2, it avoids impulsive decisions, or helps avoid. And number 3, provides discipline. So a trading plan provides guidelines for managing risk by specifying the maximum amount of capital to allocate for each trade, setting stop losses and profit targets, and establishing rules for exiting losing trades. Because let's not forget, your risk management is not just about where's your target and where's your stop loss. It's also about how are you gonna exit a losing trade, because sometimes maybe you have a stop loss that is way, it keeps you comfortable, by the way, but you know that if you keep an eye on the markets and you understand the market conditions changing and the dynamics around it, you might decide to cut that loss soon. You know what I mean? So impulsive decisions, you're not going to be able to do them, to take them any longer, make decisions that they are impulsive, because you have a framework for making a trading plan decision based on clearly defined criteria that will reduce the impact of emotional decision making and help you remain focused on the long-term goal, which I repeat, even if you're a short-term trader, you still have a long-term goal to succeed, to gain. And discipline. Trading plan provides discipline by helping traders stick to their strategies and avoid chasing short-term gains or making arbitrary decisions based on market sentiment. So these things are very important. And as you will see, impulsive decisions, discipline, these are to do with personality traits, and trading plan helps you. And this, managing risk, is what, if you don't manage, is going to impact your emotions. So again, it's kind of related. So now let's look at the less common mistakes we talked about. It was lack of identification, it was failure to adjust your strategy, and herding behavior. By investing solely in one asset or security, traders are exposed to significant risk if that asset drops in value. Diversification helps spread risk across different assets, reducing the overall risk profile of the portfolio. That doesn't mean we have 3 open trades of 1% each. That means that we don't have 1 trade open that is 3%. Okay, instead, we can have many trades open, maybe not the correlated assets as well. For example, if you have euro dollar open, in a trade, you shouldn't have gold. you know what I mean, which is gold versus USD. It could be a stock, you know what I mean? It could be like pounds versus the dollar and the euro against the Swiss franc, for example, because you're talking about two European currencies, and then the other one is UK versus the US. Things like this. Failure to adjust your strategy. You do know that markets are constantly evolving and traders need to adapt to new trends. The news, macroeconomic factors, especially what's been happening since COVID, is just a complete sort of feeding of something new on a daily basis. Failing to do so can result in significant loss to missed opportunities or being in positions that are no longer profitable. And the herding behavior. Traders sometimes follow the crowd and enter trades based on herd behavior. You might see someone on YouTube, I don't know, which can be disastrous. It can result in buying at the top of a market or selling at the bottom, missing out of gains, and of course being caught in a market downturn. So is there some light at the end of the tunnel? Yes, guys, there is. And it all starts with how we can learn from our mistakes. Okay, and as some sort of like a recipe to success, the three things I've always tried to kind of do is embrace curiosity and confidence, practice self-reflection, and look for silver linings. Let me explain what each one of those kind of means. Now, traders who view their successes and failures through the lens of a growth mindset are more likely to see failures as opportunities to learn and improve. If you don't, you're just going to keep doing what you're doing without, of course, benefiting your investment portfolio. With this mindset, traders can approach trading challenges with curiosity and also confidence, knowing that each setback is an opportunity for growth and development rather than, depression. Practice self-reflection. Traders can use failures as opportunities to assess their own decision-making and trading processes. By reflecting on what went wrong and why, which is more important, traders can identify patterns in their behavior or biases that may have contributed to that failure. And this can help adjust the approach going forward and improve the overall performance. And then, of course, instead of focusing on what went wrong, traders can look for any positive outcomes or takeaways. Perhaps the failure provides an opportunity to test a new strategy. If you have that curiosity, as we said before, you'd be like, why did that happen? Let's have a look. And then you learn more about how the market behaves in certain conditions. You might decide not to trade those conditions, or we might come up and adopt with it, and be able to make out of from it. I did find these silver linings can help traders feel encouraged and motivated. But don't forget, encouraged and motivated is nothing to do with feeling hopeful or hopeless. So what is really the path to success? Number one, we need to identify our mistakes. Number two, we need to explore what sort of corrections we can do to completely eliminate or at least improve these mistakes, develop a plan, stick to the plan, and take notes on a journal. You have to take time to reflect on the mistake that you did instead of being mostly want to jump in back to the market to take back what the market took from you. Identify exactly what happened and why it occurred. It's very important to know the why. Try to understand what could have been done differently. And that is going to be part of your strategy or your risk management, most probably. Identify what lessons can be taken from the mistake you made and how those lessons can be applied in the future. And while you do that, you need to consider how the mistake may have provided insights into market trends, personal biases, or emotional barriers. So you need to actually create a category with like different things, because when there is a mistake, it could be because of your bias, it could be because of your emotions, it could be because of a market trend. It could be a lot of different things. It could be because of risk management. Develop a plan specific okay, plan of action for how you will avoid making the same mistake or failure in the future. So yes, you are going to make a trading plan, and then you're going to be adjusting that to ensure that the same mistakes are not repeated. And as you go, you'll be making adjustments to this plan or and to your strategy if necessary. You need to stick to that though, to the process. Okay, consistency in the process is important. We said it. So be sure to maintain a disciplined approach. That is the main reason. Monitor your progress, make necessary course corrections or tweaks as needed. And of course, take notes. Without them, guys, I don't think you're not gonna be in the path to success. No. You have to document your trades and record the lessons you learn from them. Okay, lessons you learn from them. You can even say mistake. You can give names to your mistakes. You can try them, I don't know, you can call them like emotions, or you can call them no stop loss. Or you can say, for example, market changed, and find solutions to all of these if there are any, or if you want to go ahead and do it, or you just can have a plan for not trading specific conditions so you don't make the same mistake. Okay, and you need to review that regularly, of course, and make the changes. Now, the perfect trading plan should be tailored to the individual trader's goals, the risk tolerance, and of course the trading style. However, a comprehensive plan should contain 4 main sections: market analysis, risk management, trading strategy or strategies, because you might have many, and the performance evaluation. Let's look at these sections separately. Market analysis is about analyzing the market, okay, including, of course, the identification of potential opportunities and analysis of key market drivers, including fundamentals, technicals, and sentiment. When we say market analysis, we just not talk about the charts, guys. You have to know that. I know you might be, I'm a technical guy, I don't care about the fundamentals, but well, I kind of had that thought initially too when I first started, but because I was a technical guy, but this is one of the things I've actually managed to learn from mistakes I did. That was ignoring fundamentals. So it's very important. Risk management. The strategy includes the allocation of capital for each trade, stop loss rules, and rules for exiting losing trades. Look at them. I call them rules. They have to be rules, guys. You have the rules-based approach, not going to make it. It should also detail the trader's approach to margin and leverage, because some of you may not know how to use it. Trading strategies, or E. Trading approach, including the specific trading strategies to employ and criteria for entering and exiting trades. These are criteria for exiting and exiting trades. For example, when the Bollinger Band breaks that much from whatever, that is a criteria for entering or for exiting, should be something. And it should include all the analysis. Okay, the trading strategy should include all the analysis, entry criteria, for the trade, and exit criteria for the trade, what we do during the trade, and all that stuff. And performance evaluation, traders' approach to evaluating performance, including metrics they use to track progress, frequency of evaluation, and process for making adjustments to the strategy. Now let me show you a swing trader's trading plan, for example. Let's look at a real example of each of those sections. Market analysis. There is a swing trader who specializes in trading stocks within the technology sector, and he uses fundamental analysis to identify potential trading opportunities by analyzing, of course, company financial statements, earnings reports, and industry trends. But obviously, he also uses technical analysis to identify key levels of support and resistance, as well as chart patterns to confirm his fundamental analysis. This is confirmation, guys. Fundamental analysis without technical analysis, for me, it's half, and the other way around, it's just half of your potential success. The trader uses a 1% risk per trade approach, which means they only risk 1% of their account balance on any given trade. He always uses a stop loss orders to minimize losses and follow a trading stop strategy to capture profits. I hope you know what a trading stop is. He never risks more than his predetermined loss limit and never takes trades that do not have at least a 1-to-2 risk-reward ratio. And we don't enforce that risk-reward ratio, guys. We really look at support and resistance if they're not where it should be, because it's very easy to just pull the stop loss a little bit lower or a little bit higher, or the take profit a little bit lower and higher, and make it 1-to-2. It's not how it works, okay? That's why we need to practice discipline. Now, we kind of talked about the market analysis. The strategy is a bit of a different thing, but it's a combination of fundamental and technical analysis. Primary trade stocks in the technology sector with a focus of companies with strong fundamentals and positive any surprises. Technical analysis confirms the fundamentals and the trades when there is a clear trend or break of a key level of support or resistance. The key level, guys, is where there is high activity, okay, at a specific level. Performance evaluation. The trader tracks his performance using metrics such as win-loss ratio, average gain per trade, and maximum drawdown. And this is something all of us should be aiming. Okay. And he evaluates his performance weekly and makes adjustments to his trading strategy when it's necessary. He continuously educates himself on new strategies to stay up to date with the changing market conditions. Now, let me show you a trade example. And the notes that we are making for that particular trade, you might think this is too much, but guys, you have to have that. You need to reflect on something on a particular trade. You don't know how this trade eventually is going to help you. And if this 2-minute process, okay, maybe 5-minute process is going to help you improve and ensure that you're going to minimize your losses, then this is when you'll start changing perspective about what trading is all about. Look at this, date and time, what asset we traded, entry point, for example, stop loss level and take profit level. You see that here you've got more than 2/1 risk reward ratio, right? Stop loss $2, take profit is $5. Position size, 100 shares. Reason for entry, conducted technical analysis, identified a bullish trend on the daily chart. Additionally, new catalyst indicated positive earnings expectations. Very important. What is the trade plan? Planning to hold the position for 2 to 3 days based on expected volatility. We'll exit the trade if it reaches the take profit level or if it hits the stop loss level. That's it. We set them and we'll let it go. Of course, we have to monitor. And what are the actions taken? We executed the trade on the preferred broker platform, set the stop loss and take profit levels. What was the emotional state? It was confident and comfortable with the decision. Why? Because it aligns with the strategy. Do you understand that? And the trade outcome. The stock price reached the take profit level on June 30, resulting in a profit of $500. Why? Because you got 100, you got $5 up, you have 100 shares, 50 each. That's it. Trade number 2, date and time, July 5th, 2:15. Asset, gold futures contract. Entry point, 1.8, 1,800. Stop loss, $20 lower. Take profit, $50 higher. Position size, 5 contracts. Why did he enter? Conducted both technical and fundamental analysis, a breakout above the key resistance level along with the positive macroeconomic factors supporting gold prices. Trade plan, planning to hold the position for 1 week or at least take profit, whichever comes first. Will exit if he gets the stop loss level to manage risk. Actions taken, executed, play stop loss, take profit. Always the same. Emotional state, slightly anxious due to higher risk associated with futures trading because gold is more volatile. Will closely monitor price action and adjust stop loss levels if necessary. Do you see that change? And you have to write it down because writing enforces doing it. And emotion recording. Trade outcome, gold price reached take profit, resulting in a profit of $25,000. Trade number 3, data time, euro dollar, entry point 118, stop loss 117.50, take profit 119. Position size 50,000 units. This is 50 lots. Reason for entry, technical analysis, Identify potential reversal pattern, a double bottom, along with oversold condition on the RSI. Trading plan. Plan to hold 1 to 2 days. Otherwise, we'll exit if it hits a stop loss. We'll closely track economic indicators that might impact the currency pairs. You see that? Because it is very impacted by economic indicators. We have the economic calendar to check that stuff on a daily basis. You need to know what is on the news instead of blindly opening a trade. Actions taken, executed, set stop loss, take profit. Emotional state, optimistic but aware of potential volatility. Ready to adjust the trade plan if the market conditions change. Trade outcome, take profit level, profit of 500 dollars. Well, and what do we do next? The weekly performance evaluation. What was it for the particular swing trader? Maintain discipline by adhering to the predetermined trade plans and risk management guidelines. What has happened? Market analysis techniques, including technical analysis and user analysis, proved effective in identifying profitable trading opportunities. Risk management measures such as setting stop loss levels and position sizing helped control potential losses. Did it not? Yes, it did. Trading strategy based on a combination of technical and fundamental analysis helped capitalize. Did it not? Yes, it did. You need to do that. So, why? Because by sticking to your plan, you can manage emotions, you can mitigate risks, you can maintain discipline and measure their performance. A trading plan helps manage emotions, especially during volatile markets. Otherwise, you could make irrational decisions that lead to losses. I don't know how many times we've said this today, but it's true. Your trading plan should include measures to mitigate risks or stop loss orders. If you deviate from your plan, you may expose yourself to unnecessary risks. How do you not deviate yourself? By having a plan and following it relentlessly. Sticking to your trade plan is discipline and helps you maintain a long-term perspective, increasing your chances of success. Perspective. Measure performance. Your trading plans serve as a roadmap against which you can measure your performance. Deviating from your plan can negatively impact your performance metrics, and do not leave what trade out from this. And anything else we can do? Of course, education equals knowledge. We need sources equals research. We need to adopt. It means that we have an edge. Participants who lack comprehensive understanding of the markets cannot employ a disciplined approach to trading. You have to know what everything you deal with is. Guys, fundamentals, technicals. Trading is not just opening the charts, putting 1K in and start trading. It's not how it works. You need to find reliable sources of information and research, as misinformation can lead to poor decision making and further losses. Also, poor information and misinformation can be the herding technique we talked about before, right? And adopting and creating the edge. By adopting a rigorous and disciplined approach to learning using reliable sources, traders can develop a trading strategy that is grounded in sound principles and techniques and eventually avoid common mistakes and pitfalls. So what happens if you don't do that though? Well, here's what's happening. You're gonna have blurred thinking, because lack of proper education knowledge can lead to emotional decision making, and you will feel overwhelmed or uncertain about trading abilities or other things. That in turn will exacerbate that, and emotional decision making will affect your poor risk, your risk management, as impulsive trades may result in increased losses or loss position size without consideration of risk. Well, although then that will amplify the situation and the impact of poor trading strategies, leading to significant drawdowns and potential account depletion even. And finally, if that gets compounded in the end, because these are kind of the steps that all of us have actually gone through, can result in a cycle of losses, frustration, and reduced confidence, making it challenging for traders to recover and achieve long-term success. Hence the 2-year, sort of the quitters. You don't want to be a quitter or a loser. You're going to be on the winner side, and you don't need to be a prop trader frame. You just need to have a trading plan and follow it. So what are the key takeaways today? Educate yourself. Develop a robust trading plan. Embrace emotional intelligence. Enforce effective risk management. Enforce it. Practice discipline and patience, and reflect and continuous improve. That, of course, the reflection includes the notes that we need to take on the journal and about our trades. Okay, so thank you very much for your attention. I hope that is was a very useful webinar for you, and the information, the insights that you received here today are going to help you moving forward. And I do very hope that you're going to implement some of the things at least that you've learned here today, because the goal of this webinar was, as I said before in the beginning, is to equip you with the knowledge. I cannot make you do anything, but I can give you the knowledge of what needs to be done to not guarantee success, but to improve your chances of being on the winning side. Any questions? Okay, what has hindered my success in the market and how did I overcome? Here's the thing, guys. I mean, everything we did here today, it's not really coming from books and stuff. It's mainly coming from, its original comes from my own experience, right? And I will tell you that when I first started trading, I was very, very disciplined. I was following the rules of the strategy and proper risk management and everything. It's just, I think my early day success was what gave me the confidence to kind of feel more like a professional trader, or I was feeling like, oh, I'm so cool. Look, I'm actually making money and I haven't lost my first account, because that was true back then until I lost my first account. But I started very, very successfully. This gave me the confidence to say to myself, oh, I'm not going to use the trading plan now. I'm going to use the rules. I'm not going to use anything. I'm just going to do it by eye. And this is what drove me to my first account loss. Okay, and immediately I realized that I started very good. Emotions took me down, but then reasoning and the perspective I had started with, and the fact that I've experienced that sort of winning stage initially, was what helped me get back on my feet. And I am where I am today. Any more questions? Well, with no more questions, let's see a few people here, but well, thank you for joining, guys, today as we explore the world of trading and uncover strategies to master common pitfalls. I hope, as I said before, this webinar equip you with valuable insights to improve your trading journey. Remember that with the right knowledge and mindset, you can also rise above the challenges and be part of that 1%.